Have you ever stopped to think why, even when the economy seems to be moving forward, most people feel like their financial security is moving backward? We are entering the year 2026, and the rules of the game have changed drastically. While technology advances, so do the subtle ways the system drains your capital. Today, we are going to analyze an uncomfortable reality: why 90% of people will lose their wealth or see its value significantly reduced in this new financial cycle. Welcome to Capital Strategist. I am not here to scare you, but to act as your trusted guide. My goal is to educate and inform you in a simple way, so you do not become part of that statistic. Most people focus on how much money they earn, but very few understand the concept of capital erosion. Net worth is not lost only through bad stock market investments. It is lost through a lack of banking strategy and by ignoring the invisible risks the system does not warn you about. In the next few minutes, we are going to break down the mechanisms of asset protection that financial institutions rarely mention. We will talk about wealth preservation and how small information gaps can destroy years of effort. If you value your money and want to shield your future, this analysis is fundamental. This is not just a finance video. It is a survival manual to protect what is yours in an increasingly complex financial environment. Stay with me, because understanding the difference between saving and being protected will define your economic situation by the end of this year. To understand the risk we face, we must look at the raw data being reported by United States federal agencies. The biggest enemy of your pocket is not a lack of income, but what we call the information gap. According to the most recent reports from the Consumer Financial Protection Bureau, known by its initials as the CFPB, complaints regarding account management errors and hidden fees have risen to unprecedented levels in the last fiscal cycle. The FTC, or Federal Trade Commission, has revealed that the transfer of wealth from savers to institutions through administrative charges and lack of transparency has exceeded $10 billion annually. What do these figures really tell us? In my analysis, they suggest that the system profits from your lack of financial literacy. Most users believe that having their money in a traditional bank account is synonymous with wealth preservation, but the data shows otherwise. Between maintenance fees, inflation eating away at your purchasing power, and interest rate inefficiencies, static money is evaporating. Additionally, we must talk about FDIC insurance. There is massive confusion about what this actually covers. The FDIC protects your deposits against bank failure up to certain limits, but it does not protect you against the silent erosion of fees or the financial liability errors you make by not knowing your rights. 90% of people will lose their wealth simply because they blindly trust an infrastructure that has its own commercial interests. My job today is to close that information gap so you can be among the 10% who knows exactly how every dollar moves in their net worth. Let us get into the educational part that will transform the way you look at your bank. To protect your money, you must first understand the architecture of your legal responsibility. This is where concepts like Regulation E and Regulation Z become vital for your banking strategy. Let us talk about Regulation E. This is the law that governs your debit cards and electronic transfers. The big risk here is that in a debit transaction, you are exposing your direct liquidity. If someone compromises your account, your real money vanishes from the bank while the investigation is carried out. In contrast, a financial strategist uses Regulation Z, which protects credit cards. In this case, if there is fraud, the money at stake belongs to the institution and not you. Understanding this technical difference is the first step toward true asset protection. Another critical point is financial liability. The modern banking system expects you to be the auditor of your own accounts. If you do not report an erroneous charge or an abusive fee within the legal timeframes, the bank is no longer obligated to return that money. We are talking about many people losing hundreds of dollars a year to ghost subscriptions and small service charges that the bank applies automatically. Furthermore, we must analyze the structure of so-called free accounts. In my experience, nothing is truly free in the financial sector. If you do not pay a monthly fee, the bank is monetizing your money in other ways, often offering you interest rates close to 0%, while they lend your capital at much higher rates. This is legal, but it is not efficient for your wealth. Learning to navigate these terms, understanding when and why you are being charged, and demanding clarity in contracts is what separates an average saver from a financial strategist. You do not need to be a stock market expert. You need to be an expert in defending your own cash flow. Now that you understand the risks, it is time to execute a real action plan. My goal is for you to take simple but powerful steps today to look after your money. Here are the steps I personally follow to shield my wealth. Step number 1, liquidity optimization. Move your emergency savings to high-yield savings accounts. Make sure the entity is backed by the AEFDIC. In today's market, leaving your money in a checking account that pays no interest is allowing inflation to win the battle. Look for competitive rates that assist in wealth preservation. Step number 2, automated monitoring. Activate all push notifications on your mobile app. You should receive an alert for every single dollar that leaves your account. In the United States legal framework, time is money. Reporting an anomaly within the first 24 hours drastically reduces your financial liability. Step number 3, quarterly review of terms. Call your bank and ask if there are new account structures that eliminate maintenance fees or offer better benefits for your balance level. Often, banks launch modern products and keep old customers on obsolete, expensive contracts. Step number 4, risk separation. Do not use your primary savings account for online purchases or subscriptions. Create a secondary account for operating expenses and keep the bulk of your net worth in a restricted access account with no debit card linked to it. These steps do not require a financial investment. They only require discipline and a clear banking strategy. By doing this, you immediately place yourself outside the group that will see their wealth eroded by neglect. As we conclude this analysis, I want you to reflect on the value of prudence. Financial security is not about predicting the future, but about being prepared for any scenario in the present. Most people fail because they trust the system to look after them, but the reality is that no one has more interest in protecting their money than you do. As the legendary investor Charlie Munger once said, the first rule of investment is not to lose money. The second rule is never to forget the first. In the context of financial protection, this means that avoiding a loss from fees or fraud is just as valuable as earning that same money in the market. Prudence is the foundation of lasting wealth. My mission at Capital Strategist is to empower you through education. If this information has helped you see your relationship with money from a more secure perspective, I invite you to subscribe to the channel. Your support allows us to continue investigating and analyzing what happens behind the scenes in financial institutions. Leave a comment with the word protection if you are going to review your statements today. Sharing this content could help a friend or family member avoid being part of that 90% who will see their wealth impacted in 2026. Thank you for trusting me as your guide today. Stay tuned for our next video, where we will analyze how to protect your financial identity in the age of artificial intelligence. Take control of your capital and secure your future. I will see you in the next one.